Have you ever wondered why trading was not popular back in the day? I know you must have been wondering because just recently, let's say around the early 2000s, we started hearing so much about trading, started hearing so much about Forex and stock market and all of that. But before, it was more like a hidden thing, only meant for the rich, or meant for not even the rich, because how many rich people could even afford to trade Forex? So it was more like something that was meant for the institutions, the banks. In fact, a lot of people hardly even heard about it. But things have changed. And all this change can be attributed to the fact that brokers stepped in and made trading possible for everybody. And how did they do this? Brokers came in and introduced something called leverage. And through this leverage, you and I can now participate in the forex market as players. Yes, we can now risk our $100, we can risk our $500, we can risk our $10,000 because of what we call leverage. And brokers, as I said before, are the ones that make this possible. So hang on with me as I open your eyes to how leverage affects your trading and importance of leverage, and a little history on how all of this happened. Stick with me. Now, what do brokers do? Brokers provide a platform where you and I can trade currencies, and they make money by taking spreads and commissions and swap fees and all of that. So now that you know that brokers introduced leverage and flipped the script, making it possible for everyone to trade Forex. Now, what is leverage exactly? The leverage is basically you borrowing money from your broker to allow you to be able to control a large trading position, which you initially couldn't have been able to control with your small amount of capital. For instance, you need to control a trading volume of $10,000 and you don't have that, you have just $100. Now, with your $100 and the leverage provided by the broker, you can be able to trade as if you have $10,000 in your trading account. So, for example, if your broker offers you a leverage of 1:100, yeah, because it is actually represented in ratio 1:100, 1:10, 1:1,000, and all of that. So imagine if your broker allows you to trade with a leverage of 1:100, and let's say you want to take a trade, you want to hold a position that requires you to have $10,000 in your account. With your $100 and the leverage of 1:100, you can trade as if you have $10,000. You can control the trading volume worth 100 times your initial capital because of that leverage. So which means you can now trade as if you have $10,000 in your trading account. However, there are two sides to this. Leverage is a good thing, and at the same time, leverage can also do you bad. What do I mean by this? You can think of leverage as a double-edged sword. Just as leverage can make you realize profit quickly with a small amount of capital, that is the same way leverage can amplify your ability to lose a lot of money. Leverage can make you lose all your money at once, and it can also make you to make so much money at once if you know how to apply it properly. If you don't have the right knowledge, you're just going to find yourself suffering as a result of leverage. So thanks to brokers and leverage, forex trading is now possible for everyone, including you and I, not just the bankers, not just the institutions, not just the hedge funds and all of those big players. Everyone can now be a partaker in this very liquid market, in this very liquid financial instrument. You understand? So if you found this video very helpful, subscribe, like this video, and drop what you want to know, or drop your questions about what you want to know in the comment section. Perhaps I might just treat it in the next video.